Alrighty, guys, we're going into chapter 4. This is going to be continuing the accounting cycle. This is chapter 4, part 1, video summary, or just video. So this is going to be how we're going to start doing and working on the adjustments as well. All right. So last week we actually started with the journal and ledgers. Now we're going to do journal and ledgers, and then explaining adjustments. If we need to make any adjustments, let's say that we recorded in the wrong account, or if we forgot to write something or record something in an account, this is how we're going to do it. Okay, so the accounting cycle, remember, is where you have your business transaction. You actually go ahead and record it on that day that it was done. You post it to the journal, then you post it to the correct ledger that it falls under. Then you do the trial balance to make sure that you're balancing out. If not, then you go back and find out what's going on. Then after that, you do your trial balance. Now, on your trial balance, what you're doing is we're adding one more area, which is your adjustments. Again, if we forgot something, we're adding it in. Then we do another trial balance, the adjusted trial balance with anything that we forgot. And now we go ahead and continue the income statement, the balance sheet as well, and the income statement, statement of owner's equity, and balance sheet. The only difference is the fact that you're going to be seeing some of the beginnings of the financial statements on the worksheet. Okay, so again, this is going to be used to preparing our worksheet, is to organize the data. We making sure that we have everything correct so that we know where everything is. And can you imagine before this? Now you can keep it in a spreadsheet. Before, you were keeping it in an actual book, a ledger, a regular trial balance ledger, where you had your ledger, you had then your general ledgers, and you had to post to each one. And that's why you have the page numbers, so you could remember where it was coming from and why it was posted there. Electronically now, you have several kinds of things that you can use. You can use Excel, or you can use an accounting software such as QuickBooks. But for us, this is what the sample worksheet is going to look like, where you have your trial balance, getting your balances from the general journal and putting them in. Now you see your adjustments, and this is where you're going to make any adjustments that you need to any of the accounts that are there, or accounts that you have forgotten to put in. And by accounts, I'm saying that you forgot to put in transactions that you forgot to record. Okay, that's what I'm talking about. So when you're doing the internal entries or adjusting entries, you need to bring the accounts up to date, and of course recognize the revenues and the expenses in the proper accounting period, be it the day, the month, the year, whatever it needs to be. So usually items that need to be adjusted are things such as prepaid rent, equipment, depreciation, expenses, salaries, supplies, whatever we're purchasing. Now, in appreciation on equipment, when you buy something such as a car, what ends up happening is that as soon as it goes off the lot, it depreciates in value, meaning that the value comes down. So what you're going to do is every month record the decreasing value of equipment, be it a car, be it a tractor, be it a tiller, whatever the case may be. Sewing machine, a big industrial machine, decreasing the value because you're using it, and then recording the amount of times that you've brought the value of the equipment down, that you've decreased it. That's depreciation, decreasing the value of equipment, and accumulated means the total so far, for have it be months or even years, how much you've accumulated as far as the depreciation, because there is a set amount that you figure out. as far as how much you want to depreciate it, as far as saying that it's of a certain value now. So this is what we do. For example, let's say that on the computer supplies account, we purchase supplies of $600, inventory supplies of $100, supplies used was $500, okay? Supplies used becomes an expense. So see what happens here. You have computer supplies because you purchased them, right? You put them in the computer supplies account. But when you take the inventory of how much you have, you only have left $100 worth. So it shows where you have used up $500 worth of computer supplies, be it paper, toner, whatever the case may be. So computer supplies now expense is $500, right? It's debited $500, and then you credit the computer supplies of $500 so you can come up to the amount that you should show after taking a physical inventory. Again, prepaid rent. This is rent that you've given, let's say, to somebody that you are renting the building from, okay? You decide that I'm going to give you 3 months in advance. So what you're going to do is show each month of that decreasing prepaid rent amount. So here you're showing that you've paid rent for 3 months, which equals to $1,200. 1 month's rent then is $400. So the rent that you've used for that month is $400. So you debit the rent expense and then decrease or credit the prepaid rent account. That is an asset because you've got money set aside, and you decrease it by $400, giving you then a balance of $800. Okay? Again, adjusting the accounts that you have. You have equipment. Again, so what you're doing is you're saying, okay, this is how much I'm going to depreciate this equipment, this car, this truck, this industrial sewing machine for a year or for over so many years. So the equipment is decided on as far as depreciation, how useful it's going to be over how many years. Typically, a car is depreciated about 5 years as well, because after a certain amount of time, after 5 years, things start to go bad. Things start to need a lot of maintenance. So you're going to take the historical cost, which is $6,000. Then you've decided that you're going to reduce it by $1,200 each year, or $1,200 of the residual value. That's how much you're going to have left over 5 years. So if you decide that $6,000 minus $1,200 over 5 years, you would get how much you're going to be depreciating this per year, which means that if you're depreciating that per year, then you would still have to divide this by 12 months to determine how many months you're going to go ahead and depreciate it. And don't worry, in our assignments, it usually gives you the amount of depreciation per year, okay? We'll talk about this a little bit more. So, here we go. If it's $900 per year that you are depreciating, then it is, once you divide it by 12, it's $80 per month. So depreciation then becomes an expense. So what you're doing is you're going to debit depreciation expense on the computer equipment. This is computer equipment. And then you're going to credit the accumulated depreciation account so that you can record how many times and what the value is, so that at the end of the year, you should get up to $960 of depreciation for the computer equipment, okay? So then, to analyze and adjust the accounts, you're going to keep a running total of depreciation, and that's what accumulated depreciation is. So the computer equipment was $6,000. Once you figured out how much you're going to be taking out, then your accumulated depreciation is $80 each month. So your computer equipment historically is still $6,000, but now in your in your accumulated depreciation, you're taking out the $80. So now what you're doing is you're carrying the book value of your equipment to show that now it's only worth $1,520. So it's $5,920. People do this for cars all the time. For example, let's say that you've had your car only 3 years, but still, what does Kelley Blue Book, which is the depreciation, show how much based on the years, based on the car, color, and the amount of mileage that you have, and what it looks like inside, how much depreciation or how much your car has gone down in value. What is that? What does that look like? So, we also adjust salaries. Let's say that salaries accrued. That means that salaries, how much you're going to go ahead and have to pay. So let's say that John worked May 28th, 29th, 30th, and the 31st. This is a $350 expense in May. It is accrued, or it is totaled in salaries payable until it's paid, meaning you owe John this money and you're going to pay him. So what you're going to do is you're debiting your office salaries expense to show how much it is for that month in May. Salaries payable, you credit salaries payable to show that you're going to pay him later on. Okay? You've come to an agreement. Now what we're going to do is we're going to go into what this looks like on the worksheet. Okay? Hold on.